Hey, Kelly, that's right. It may sound like a first-class problem, but founders are increasingly collecting investor cash while giving them unequal voting rights. And it's not just your run-of-the-mill dual-class share structure we're talking about here. Now, triple and even quadruple classes are becoming more mainstream. Just in the last few days, for example, DoorDash revealed that it's going public with Class A, B, and C stock. Airbnb disclosed an S1 with 4 classes of stock, A, B, C, and H. The H class going toward an endowment for hosts on its platform. In recent years, issuers have gotten more creative with their classes of shares. Snap was the first to issue non-voting shares in its debut back in 2017. Earlier this year, Palantir introduced an F class of shares that allowed its founders to sell stock and still maintain their voting rights. Now, institutional investors are often opposed to relegated control, and studies have shown that multiple classes of stock can lead to weaker corporate governance, less diversity, and even in certain cases, underperformance. Controlled companies argue, however, that these structures prevent management from needing to bend to short-term needs of the market, giving strategies time to play out. Cal.
All right, Leslie, appreciate it. Leslie Picker. The jury's still out on the merits of multi-class structure companies for investors, since so many are recent IPOs. Should there be more pushback on this trend, and should investors avoid these kind of listings? Joining me now is Duncan Davidson. He's a partner at Bullpen Capital. Duncan, it's good to see you again. And can we paint all of these different share structures with the same brush, or are there specific kinds that people need to stay away from?
You could paint them all with the same brush. They all have the same goal, to maintain control. And it's a big question in the VC community. Do we want this to happen? But when a star founder comes in, you let it happen.
This reminds me a little bit of the debates we've had over the likes of Facebook, but also, in fairness, I mean, media companies have been doing this as well for a long, long time. So in that sense, it's not new or unique to Silicon Valley. But there's something that goes a step beyond when you see what Palantir, Airbnb, and DoorDash are doing. We're not talking about 2 classes anymore. We're talking about 3 and 4. How much more of this do you expect?
I think creativity will expand it to stupid levels. Look, the point about this, though, is your introduction is exactly right. People are afraid that they'll be prematurely put into a profit path when they want to grow. Understand, the great internet land grab is on. Huge franchises are being created right now. So this is not the time for people to manage to profit. They should instead grow at all costs. So as I put it, let the founders channel their inner Steve Jobs or Elon Musk and create a great company. That's the choice you're making. Do you bet on that, or do you bet on going to profit? You should bet on growth.
But is there a fundamental principle here that's getting lost? I mean, it seems to me what's happening is that companies are basically trying to conflate 2 things to say we want the control of being private with the benefits of being public. So we're going to give people access to our shares, but not let them have any control. Well, the whole point of these structures is that investors are owners in the company, that they have a say, right? I mean, aren't we turning some of these fundamental issues in finance on their head?
I think what the tech people are afraid of is the following. In general, there's been no second act in a tech company. When Steve Jobs left Apple, it was fading. He had to come back. There's a number of examples where when the founding energy goes away, the company does not take off like crazy. It sort of fades. So the bet you're making is to keep that energy in the company and not prematurely take it out. What these companies really are worried about is suddenly a corporate raider comes in, or a PE firm tries to strip all the profit out, increase the dividend, et cetera, and they never will ever achieve their second act in growth. Now, it won't always work. Some of these companies will fade and screw up, and you wish you could get rid of the founders. But you're making a bet right now, the internet land grab bet versus profit. So right now, the time is make the bet.
Shepard Smith here. Thanks for watching CNBC on YouTube.